The only difference between inflation and hyperinflation is trust. And a lot of people don't realize that. But if you go back and you study these systems and you study what happens, there's no one mathematical point in time where you can say, oh, once they breached this amount of printing, or once they did this, then that's when we went from inflation to hyperinflation. No, every single time the catalyst is always the trust of the people. And that's what makes this current banking crisis so serious. It's not about that the banks are going to close and your money isn't going to be there. Your money's going to be there. Honestly, you shouldn't be worried about your money in the bank. You should be worried about how much you're going to be able to buy with the money in the bank. The real issue is they are diluting the dollar at such a fast pace that if you think prices went up quickly from 2020 until 2023, wait until you see what happens to prices from 2023 to 2026. It is going to get more violent, more volatile, and more aggressive than it's ever been because they are not pumping the brakes, even though they say they are. They are pressing the gas. And when they're doing this, putting $2 trillion in right now, who knows what other banks are going to be exposed. Banking balance sheets are worth shit, and it's fractional reserves. So what? The government comes in and says, well, we're going to value your collateral at par. So all that principal value loss from buying treasuries at low yield and holding them all the way up as the yields rise, all that principal value loss, you don't have to worry about it. Well, that's fine. But reserves aren't backed one-to-one. Reserves, there is no reserve requirement. After COVID, they never changed that back. If a bank, even a big bank who properly hedged their risk, has to sell off because depositors want their money, not all of that reserve is kept in perfectly liquid cash equivalents. Banks would have to start selling off assets. And guess what? If they start selling off assets, that means they're going to be pulling liquidity from the market. Whenever you're using big positions, there's always a slippage factor. You have to figure out how much of the book that you can actually take. If these banks start taking big portions of the books, it's a doom loop. All the banks have to sell off their assets all at the same time to raise the reserves to actually give for the withdrawal demand, and prices would crater. So, and are they going to let that happen? No, they're just going to provide liquidity. But guess what? When you provide liquidity, that's the definition of inflation.